Good afternoon. Thank you all and welcome. We really appreciate you joining this afternoon's webinar. We have two great panels for you this afternoon, and I want to make sure we get right to the content, which is even more important in times like these. My name is Teresa Singleton, and I am Senior Vice President and Community Affairs Officer for the Federal Reserve Bank of Philadelphia, and it's my great pleasure to welcome you to today's session, Advancing Homeownership Opportunity to Narrow Racial Disparities. For many years, our research and data analysis have highlighted the ongoing racial disparities in credit access and home ownership. However, the data also allow us to better evaluate the why. Why do these disparities persist, and how? How can policy and programs be more effectively deployed to address the root causes of these disparities? Today's webinar is part of a broader dialogue where we can find and leverage solutions that will address these disparities, which have such negative impacts on individuals, communities, and ultimately the economy. We are so thrilled to have these fantastic panels to discuss new federal initiatives to address issues related to homeownership inequality. We have two panels for you today. The first will highlight 5 federal programs with representatives from federal regulators and the GSEs. And the second panel will focus on leveraging and enhancing these programs. There is a lot happening in the housing policy space, and we are going to try to cover as much as we effectively can in this session. In addition to the 5 federal programs that will be focused on today, many of you are aware that the Federal Reserve Board, the OCC, and the FDIC recently issued a notice of proposed rulemaking that would amend CRA regulations. The rule, once finalized and adopted, would have significant impact on access to credit and home ownership, and you are encouraged to submit comments on the NPR by August 5th, 2022, and you can do so through the board's website. So we'll drop a link in the chat to make it easier for you all to find. Additionally, we will host another session in this webinar series on local solutions to this very same challenge, when we hope to discuss this and other topics in more detail. I'd like to end by thanking our partners on this series, the Urban Institute and the Penn Institute for Urban Research. Maintaining our focus on important issues such as these is only possible because of the expertise and commitment of people like Susan Wachter, Yannicka Radcliffe, and Laurie Goodman. And so with that, I'd like to hand it over to Laurie to kick us off with our first panel.
Great. Well, thank you so much for joining us today. We really appreciate your coming. My name's Laurie Goodman, and I'm an Institute Fellow at the Housing Finance Policy Center at the Urban Institute. Our first panel today, as Teresa mentioned, is going to focus on federal initiatives that will serve to advance homeownership opportunity and in turn lead to narrower racial disparities. We all know there's not one reason for the disparities. Certainly, differences in wealth, income, and education play a role, but improvements in the mortgage process could move the needle substantially in closing these gaps. There are a variety of actions that have been taken or will shortly be taken to help close these gaps, from appraisals to underwriting criteria to available loan products. We're very excited about these initiatives. Some of them have already been implemented or are in the process of being implemented, and we're very excited about this wonderful panel, as these are the people in their respective organizations that have been the main point people on these initiatives. So let me introduce my stellar panel, and then we're going to move from one to the other. Melody Taylor is the Executive Director of the Property Appraisal and Valuation Equity Task Force from HUD, and she's going to talk about the findings of the task force, which is known as PAVE. Frank Vespa Palaleo is the Deputy Fair Lending Director of the CFPB, and he's going to talk about special purpose credit programs. James Wiley is the Associate Director for Fair Lending of FHFA, and he's going to speak on a variety of lending advancements for the GSEs, including thoughts on pricing disparities and language preferences. Stacy Schiffman is a Senior Director of the Single Family Analytics and Modeling for Fannie Mae, and she's going to talk about including rental payments into the mortgage application process. And finally, Simone Beatty is the Senior Director of Affordable Lending for Freddie Mac, And she's going to talk about Freddie Mac's new Choice Renovation Express program, which vastly improves the choice set for renovation financing. So with that, let me turn to Melody to get started. Melody?
Hi, and thank you so much for having me today. Hope I'm not having technical difficulties here. So sorry.
You're perfect.
Okay, great. Thank you. So I'm Melody Taylor, and for the last 10 months, I've had the honor of being the executive director of the Property Valuation and Equity Task Force, excuse me, got tongue-tied there. PAVE, as we call it. I'm so pleased to be with you today to talk about the recently released PAVE Action Plan. And to begin, I'd like to acknowledge that many of you are already very, very familiar with the action plan. And so my presentation today will focus on high-level themes around how we centered the plan and how we evaluated appraisal bias. I appreciate the support and, quite honestly, the feedback. We've heard from over 150 stakeholders, academics, advocates, researchers, the industry. And so we listened to what was shared, and we made sure that those ideas, thoughts, considerations were embedded in the report. Next slide. When we launched the PAVE Action Plan in March, it represented the most wide-ranging set of reforms ever put forward to advance equity in the appraisal process. A little more than a month ago, I'm delighted when I say this, the task force chaired and co-chaired by HUD Secretary Marsha Fudge and Domestic Policy Advisor Susan Rice joined the Vice President of the United States in a heartfelt endorsement and adoption of this PAVE Action Plan. The task force is the first of its kind interagency initiative to address racial bias in home appraisals, and it included principles from 13 cabinet level and independent agencies and components of the Executive Office of the President. The release of the action plan capped months of hard work and determination by a team of federal and independent agencies seeking to speak in one voice and aligning and harmonizing regulations that all families and neighborhoods will have a better chance to build intergenerational wealth through home ownership, and including communities of color. So I want to underscore that the task force, its work has always been about individuals like you, industry, philanthropy, government, and others who can collaborate to ensure fairness in the appraisal process so that all of us can benefit from the American dream and build wealth for our future generations. Next slide, please. From the onset of the task force, we approached the issue with solutions in mind. The action plan details a set of commitments and actions, most of which can be taken using existing federal authorities, which was critically important. We did not want to create big policy that didn't meet people, and we're really squarely focused on being able to create opportunities for each of the independent agencies to create solutions within their purview. As I mentioned earlier, we heard from the community engaged, a host of stakeholder groups in order to formulate and embed some of the issues that I'm going to talk to you about today. So the report, you can move to the next slide, is centered around 4 themes. And those themes are making the appraisal industry more accountable. So the action plan lays out steps to enhance oversight and accountability of the appraisal industry, which, as you know, has long operated in a relatively closed and self-regulated framework and has not been effective at addressing deep-rooted inequities. The next theme is empowering consumers with information and assistance. The action plan includes concrete efforts to empower homeowners and homebuyers on effective steps they can take when they receive a valuation, for example, that's lower than expected. We also focused the report on preventing algorithmic bias in home valuation. Federal agencies that regulate mortgage financing commit to including non-discrimination quality control standards as a part of forthcoming proposed rulemaking. Also, cultivating an appraisal profession that's well-trained and looks like the communities that it serves. As we know, and I'm pretty sure many of you have heard throughout the year of the Department of Labor's statistics surrounding the appraisal industry, which is roughly 97% white, making it one of the least diverse professions in the country. And so the action plan lays out a series of actions to remove unnecessary educational and experience requirements that makes it difficult for underrepresented groups to access the profession and to strengthen anti-bias, fair housing and fair lending training of existing appraisers. And lastly, I think very important to note here is leveraging federal data and the expertise to inform policy practices and research. So what we knew is we had 180 days to formulate this report. So we were not able to capture all things. And what was acutely recognized throughout that process was that access to data drives decisions, it drives research, and it's something that at this current juncture has not been aggregated, and there's not source data for any one industry to be able to focus on from a public perspective. And so what the action plan does is commit the department and the federal agencies into exploring opportunities to create a repository to aggregate data that could be and has the potential to be public facing, which we believe will create great opportunities for research and to better understand where appraisal bias exists more broadly in our communities. I'll add a couple more notes and then I'll close out because I know that I do have limited time here. But the plan includes 21 unique agency actions identified to combat appraisal bias. There are over 42 discrete commitments identified and pledged for completion by the participating task force agencies. And just like to note that the 13 agencies that participated in this process each made commitments to doing this work and to combating appraisal bias, which is honorable and notable. In the coming months, the task force, again, will initiate several areas of additional research. As I mentioned, we had 180 days to do this work, and so we know that there's more work to be done. We're going to be looking at and taking into consideration expanding the use of alternatives to traditional appraisals. And that could include hybrid appraisals, desktop appraisals, AVMs, and other alternative methods. We also want to explore the use of range of value estimates. These are things that we heard from the industry, right? So instead of point estimates as a means of reducing the impact of bias in appraisals, to look at range of value estimates. And additionally, we'll review the potential use of alternatives and modifications to the sales comparison approach, things that may yield more accurate and equitable home valuations. So I'd just like to close by saying, we know that since the release of the action plan that there have been undoubtedly the questions of whether we evaluated or relied upon enough or the right data to show that appraisal bias exists and has been a public point of contention. But what we know is that 54 years since the passage of the Fair Housing Act, housing and the homeownership gap is wider than ever. We think that this action plan provides a milestone, not a capstone. The action plan takes into consideration, the aggregation of data and establishing a repository for that data that has the potential to amplify the pervasiveness of this issue. And so as we transition into implementation and prioritizing the action items, we will work and look to industry to collaborate and continue the rich dialogue that has already been a trigger and has catalyzed this process to inform and enact changes that are long overdue. We ask that you visit our website to learn more and to feel free to email me or members of the team at pave@hud.gov. And I thank you so much for your time and welcome any questions.
Thank you very much, Melody. That was a fabulous presentation. Very good. And the PAVE report is absolutely required reading for anyone in this field. With that, we're going to move to Frank Vespa-Papalio from the CFPB, who's going to talk about special purpose credit programs.
Thank you, Laurie. Thanks everybody for the invitation, for the opportunity to be here today. This is very much appreciated. I'm going to talk about special purpose credit programs, and special purpose credit programs represent a significant voluntary opportunity for lenders to address racial wealth inequality and other disparities. Far too many minority households and businesses continue to lack fair and equitable access to credit. And this critical unmet need, coupled with historical and ongoing discrimination such as redlining, have exacerbated the racial wealth divide and continue to leave many communities shut out and underserved by lenders. And research has shown that the average white family has 8 times more wealth than the average Black family. Research also indicates that Black and Hispanic credit applicants are often denied at higher rates, and minority small business owners are often approved for smaller amounts of financing than their white counterparts. And the Special Purpose Credit Program provisions of the Equal Credit Opportunity Act, or ECOA, provide targeted means by which lenders can better serve communities who have been historically shut out or otherwise disadvantaged. For those that need a little refresher or information, I'm going to give some background on ECOA, which is the federal civil rights law that prohibits discrimination regarding any aspect of a credit transaction for certain protected characteristics, which include race and color, religion, national origin, sex, which includes sexual orientation and gender identity, marital status, age, and receiving public money from public assistance. And then also for exercising in good faith consumers' rights under the Consumer Credit Protection Act. In addition to specifying in ECOA what is prohibited, the statute also clarifies what is not considered discrimination. In those provisions, Congress clarified that it does not constitute discrimination under ECOA when a lender refuses to extend credit offered pursuant to a special purpose credit program, which is why we're here today. The statute also grants the CFPB the authority to prescribe the standards for special purpose credit programs outlined in ECOA's implementing regulation called Regulation B. Although ECOA has been around for over 45 years now, the special purpose credit program provisions have been severely underutilized. Under Reg B, Regulation B, lenders are permitted under certain conditions to design and implement special purpose credit programs to extend credit to a class of persons who would otherwise be denied credit or who would receive it on less favorable terms. In particular, Reg B permits 3 types of special purpose credit programs. The first type of program permitted by the regs includes any credit assistance program authorized by federal or state law, which must be for the benefit of an economically disadvantaged class of persons. This includes programs that are offered pursuant to federal, state, or local statute, regulation, or ordinance, or pursuant to even judicial or administrative orders. The second type includes any credit assistance program offered by a nonprofit organization, which must be for the benefit of its members or the benefit of an economically disadvantaged class of persons. And finally, the third type includes any program offered by a for-profit organization or in which such an organization participates to meet special social needs if it meets certain standards prescribed by the CFPB and Reg B. There are different requirements for special purpose credit programs depending on whether the entity offering it is a nonprofit or for-profit organizations. These are all listed and explained in Regulation B. And the slide that's on the screen is a list of some resources that you can, where you can find the actual content of Regulation B and some materials that I'll be discussing. As explained in greater detail in the regulation itself, for nonprofit organizations such as credit unions or certain CDFIs, for example, a special purpose credit program only has to consist of a credit assistance program that benefits either its members or an economically disadvantaged class of persons. For those offered by for-profit organizations, there's more that has to be done. Those organizations that are for-profit that want to roll out a special purpose credit program must do so to meet special social needs. And the regulation requires that they produce a written plan. Two, that the purposes of extending credit to a class of persons likely to otherwise be denied or receive credit on less favorable terms. And in contrast to the, for the application for those who are for-profit organizations, Reg B does not require an official written plan or any evaluation of a nonprofit organization's customary standards of creditworthiness. So that's a major difference between for-profit and non-for-profit entities that pursue the rollout of a special purpose credit program. It's important to note that requiring a special purpose credit program must be for the benefit of economically disadvantaged persons or to meet special social needs. Means that the program must be advantageous to the identified class and not predatory. This past February, the CFPB joined 7 other federal agencies, including several that are here today on this panel, in issuing a first ever interagency statement to encourage lenders to explore opportunities to increase the use of special purpose credit programs to address historically disadvantaged individuals and communities. And the agencies felt it was important enough to speak with one voice to highlight these important opportunities under COA and Regulation D. And there's a link to that interagency statement, which is the second bullet on this slide on the screen. The interagency statement calls attention to the special purpose credit programs as one way to expand access to credit to critical financial services of all kinds on affordable terms, including mortgage lending. And that interagency statement highlights a 2020 advisory opinion that the Bureau issued, published in December of 2020, which is listed, the 4th bullet on this slide is the AL advisory opinion. And that addresses how to implement for-profit organizations compliant special purpose credit programs. Specifically, it includes information regarding the content of a written plan that I mentioned that establishes and administers a special purpose credit program. In addition, it provides information about the type of research and data that might be appropriate to inform a for-profit organization's special purpose credit program might be needed to benefit a certain class of persons. I will also point to the first item, I'm sorry, also in the slide deck here, the third item here is Hud Fha Guidance, which I'll point to as well. There is an opinion released in December by our friends at HUD, reaffirming that special purpose credit programs for real estate loans and credit assistance that are complying with the COA and Reg B generally do not violate the Fair Housing Act. That's an important piece of information. And you'll see there other links to helpful resources that are available online. And just really after 45 plus years of its existence, we hope that more financial institutions will take advantage of special purpose credit programs to serve historically underserved communities. And thank you again for inviting me to be part of this discussion today.
Well, thank you very much, Frank, for a great presentation. Really appreciate it. And I think you made the point that special purpose credit programs have been around for 40 years, but they haven't received wide implementation because the guidance hadn't really been in place. So this should help a lot. I really appreciate it and really appreciate the list of resources. With that, let's move on to James Wiley.
Thank you, Laurie. Good afternoon, everyone. I'm very pleased today to have the opportunity to share with you some of the things that the Federal Housing Finance Agency is doing to advance homeownership and narrow racial disparities. First, let me say thank you to the Philadelphia Federal Reserve, the Penn Institute for Urban Research, and the Urban Institute for sponsoring the event and for the invitation to speak. For those of you who may not be familiar with us, FHFA is the regulator of Fannie Mae, Freddie Mac, and the 11 federal home loan banks across the country. We're also the conservator of Fannie Mae and Freddie Mac. Together, these government-sponsored enterprises provide more than $7 trillion in funding for the US mortgage market and financial institutions. So while we are a relatively small agency, we have a big job. And we know that with that amount of money and that amount of influence that our regulated entities have on the mortgage market, that we can have a tremendous impact on access to equitable, sustainable, and affordable housing for everyone, which is why one of our strategic goals as an agency is to advance equity in housing finance and foster markets that promote equitable access to affordable and sustainable housing. So how are we doing that? Well, step one in ensuring equity is addressing discrimination. So I'll start with fair lending. We've taken several steps over the last year to really promote fair lending and ensure that we are doing our part as part of the federal regulatory community. All financial regulators actually have an obligation under the Fair Housing Act to affirmatively further fair housing, which includes cooperating with the Secretary of HUD and enforcing the Fair Housing Act. So last year, we issued a policy statement on fair lending, highlighting how we approach fair lending for our regulated entities. We also signed a memorandum of understanding with the Department of Housing and Urban Development, announcing that we're going to cooperate in ensuring fairness in the mortgage market, and whenever we can, be aligned and work with HUD toward that goal. Also, we've recently begun fulfilling a statutory provision for the first time. FHFA, going back to when it was created in 2008, there was a provision in our statute which allowed for us to do analysis of Fannie Mae and Freddie Mac data to look at whether there appear to be any pricing disparities for primary market lenders, and to refer those lenders under a preliminary determination to the appropriate regulator for follow-up. So we've begun fulfilling that statutory provision for the first time last year. We've made 2 sets of those referrals now, and this is going to be now an ongoing thing that we do as just part of our regular fair lending program. We've built a comprehensive data set and process for analyzing pricing data, and that was really influenced both by the traditional work of the federal agencies who look at fair housing pricing disparities, that methodology, as well as the public research from economists looking at mortgage pricing discrimination. So we're really proud of this work and proud to be supporting our regulatory partners in doing this. We believe that no one should be charged more for a mortgage because of their race, their ethnicity, what country they come from, or the color of their skin. We've also issued comprehensive fair lending examination guidance to Fannie Mae and Freddie Mac at the end of last year. This exam guidance is a comprehensive statement of how we apply fair lending laws to Fannie and Freddie and our expectations of them when it comes to fair lending. The exam bulletin also makes clear that fair lending is not just an expectation of the compliance department or the legal department, but the whole organization. Our exam guidance says that an effective fair lending program requires support from senior management, the board, and all business areas. And frankly, we think that should be the standard for the whole industry. I think we are learning more and more that the issues of compliance and equity are intertwined, and that you can't be successful unless you have a whole organizational strategy to approach these things. Everyone is responsible for ensuring that we have both a sustainable and an equitable housing finance system. But we know that fair lending compliance is only one aspect of how we can address this issue. We also have to think about what actions we can take to address the barriers in the mortgage finance system that we know are contributing to a significant, persistent gap in homeownership. Recently, we announced that lenders making enterprise loans will be required to collect a borrower's language preference information. This information will help identify the needs of borrowers to the industry and help us build a more equitable housing finance system that serves those borrowers. So we're very excited about that. And I think one theme that we try to take throughout our whole work is the impact that data can really have. Data is incredibly powerful in identifying those barriers, identifying the needs, and also identifying solutions. And so we feel that data is a key way in which FHFA and others can address the equity issue. We also know that reliance on traditional measures of creditworthiness often don't reflect modern credit usage. And that's why we're excited by programs that both Fannie Mae and Freddie Mac have been pursuing related to rental payment history. We think using rental payment history as part of underwriting in the mortgage process is just common sense. A borrower's rental payment is often their most substantial expense, and we think can provide a way to really move the needle, as Laurie mentioned, in innovating the mortgage finance system to better serve borrowers that it has not served as well in the past. Valuation is another key issue where we think we can make a difference. As Melody mentioned, the PAVE task force report, FHFA was a participant in that PAVE task force. We conducted a survey of appraisal records and published some examples of bias statements, demonstrating that in fact, appraisal bias is something that still happens today, unfortunately. Also, as part of the PAVE task force report, it was noted that FHFA has begun sharing data with some of its federal partners to begin addressing this issue. Again, highlighting the importance that data plays in really addressing this role. One thing we think about FHFA is really the difference between equality and equity in our work in this area. While equality means that everyone gets the same thing, equity means that we can have different programs to serve different people tailored to their needs. We think this is so important in the mortgage space, as we know different people need different products and programs. And we think this focus allows us to build a sustainable mortgage finance system that serves everyone: low-income borrowers, high-income borrowers, borrowers of color, borrowers living in rural areas. And that is really the charter mandate of the enterprises, is to serve, provide mortgage credit throughout the nation. And we think thinking about it through this lens is a helpful way to get there. Thank you very much.
Thank you. HUD recently published their guidance on special purpose credit programs. You've indicated that you all view it very positively as well. Could you talk a little bit more about spend a couple of seconds talking about a little bit more about your views, and is there guidance forthcoming on this from you all?
Sure. So Frank mentioned that there was an interagency statement on this, and FHFA has not traditionally joined the other federal financial regulators in those type of statements, but we did with this one, and so I think that should be read as an important signal. Acting Director Thompson also issued statements supportive of HUD's guidance on this, and really challenging the enterprises and the federal home loan banks to think about special purpose credit programs. So we are very supportive of this. As you mentioned, Laurie, these have been on the books for 20, 30 years. The guidance is there now, but we know that without sort of secondary market support, the benefits are going to be limited. And so we want our regulated entities to be good partners, to be thought leaders in thinking about how we can really utilize this tool that's been available, but now, the guidance is there for people to really use it. And so we're really hopeful that in the coming months, we can find ways that they can really partner with the market and find ways to make special purpose credit programs a part of the solution.
Perfect. Thank you very much. So with that, let's go to Stacy Schiffman and incorporating rental payments into the underwriting process.
Thank you, Laurie, for having me on the panel today. I'm excited to be here to talk about how Fannie Mae is working to make rent count. Credit history is a key consideration when lenders evaluate a borrower, but fewer than 5% of renters have their rent payments reported on their credit report, putting many prospective first-time homebuyers at a disadvantage. We are working with CDIA and others in the industry on CDIA's Rental Empowerment Project to increase rental reporting to the credit bureaus, but we know this will take time. As the industry works to tackle rental reporting, we wanted a way to help prospective homebuyers now. In September 2021, Fannie Mae launched an innovative feature in Desktop Underwriter that incorporates rental payment history as part of the mortgage credit evaluation process. For the first time through Fannie Mae, homebuyers who have paid rent consistently for at least 12 months can have that payment history considered by an automated underwriting system. Can we advance the slide? Sorry, I think we're going to go to the next slide too. Sorry about that. Desktop Underwriter has a service to validate a borrower's assets. This leverages a verification of asset report, which consists of consumer permissioned bank statements. Positive rent payment history utilizes a 12-month verification of asset report to identify rent payments, then considers those rent payments to enhance the credit risk assessment. The goal is to increase the likelihood of an approved eligible recommendation from desktop underwriter. But how does this work? So DU compares the monthly rent amount that's entered by the lender on the loan application to the recurring transactions on the verification of asset report to identify rent. But what if my rent fluctuates because utilities are included? No problem. DU can still find the rent. But what if there's a gap because first and last month's rent payments were paid up front? DU can account for that. What if rent is paid by check or person-to-person digital payments? No problem. DU can still find rent. What if rent is paid out of multiple accounts or by different borrowers? No problem. DU can still find rent. It is important that the lender enter the rent amount that each borrower pays rather than the total attributed to one borrower. For lenders, this is a step worth taking, both as a business opportunity and a chance to responsibly make the dream of home ownership a reality for more people. FHFA announced that as of February, over 1,000 applications have benefited from having their rent considered by desktop underwriter. It has only been a couple of months since then, but I'm happy to announce that the number benefited has doubled. Our data shows that this innovation is reaching and benefiting the underserved groups we intended to impact. Roughly 50% of applications that benefit identify as minority borrowers. But September 2021 was just the starting point, not the finish line. We're at the beginning of a journey to ensure that more of a home buyer's payment history is considered for mortgage qualification, including monthly rent. With the help of lenders and others in the housing ecosystem, including credit reporting bureaus, we look forward to a day when anyone can get credit for being a responsible renter when they want to become a homeowner. Thank you, Laurie.
Thank you very much, Stacy. That was a great presentation. I really appreciate your sharing those numbers. I hadn't seen them. That's really interesting in terms of the number of applicants that have benefited and that 50% of those applicants are minority. What happens if there's, let me ask you two follow-up questions real quickly. When DU looks at rents, what if there's a gap in the rent payments? Is it used to penalize, does it penalize the borrower, or how do you handle gaps?
Yeah, it's a great question. So no, a borrower can only benefit from permissioning their bank statement from their bank data. We cannot tell from the bank data if a borrower did not make a rent payment. We can only see the payments that they did make. So the rent payments could have been made from a different account that was not shared. It could have been paid in cash or charged to a credit card. So again, it's positive only because we can't tell if there's a gap in that history, if it really was because they missed a payment or simply paid by an alternative method that we weren't able to see.
Thank you. And you also mentioned that this is the beginning of the journey and that you intend to incorporate more types of payments. Could you be a little bit more specific on there?
Sure. Our goal is to make rent count. To do this, we need renters to get credit for the rent payments on their credit report to enhance their credit scores. This could help the renter in many aspects of their financial lives. So this could lead to lower insurance rates, lower deposits, better interest rates for loans, even a better apartment to rent. So we know that not all landlords will report rent to the credit bureaus. So Fannie Mae will continue to innovate around the use of the data and the verification of asset report to promote a more inclusive credit evaluation while strengthening the industry's ability to lend to underserved borrowers safely and soundly.
Thank you very much. That was great. So with that, let's go to Simone Beatty from Freddie Mac to talk about the Choice Renovation Express program, their new renovation program.
Yeah, thank you, Laurie. And thanks for the invitation to speak today on Freddie Mac's renovation suite that includes Choice Reno Express. So Freddie Mac's renovation products are relatively new to the market. They're approximately about 2 years old for the Choice Renovation flagship product and Green Choice Mortgage, which is the energy and water efficiency renovation product. Choice Reno Express was released less than 12 months ago, the latter part of 2021. And to kind of give you kind of how we got there, I'm going to start with Choice Renovation. So Choice Renovation, all of the products that we have in our renovation suite work in concert with and are complementary to the suite of our affordable low down payment products we offer, namely Home Possible, HFA Advantage, and Home One. And Choice Renovation really was contemplated to be a tool to support entry to homeownership, especially as more households with low and moderate income are being priced out of the market with rising home prices. And the products can be used as a wealth builder to both maintain and add value to the home. And so with Choice Renovation, a consumer can leverage this offering to essentially do a full-scale renovation where the financing can cover up to 6 months worth of what they would have paid on the new house for principal and interest, taxes, insurance, that can cover housing elsewhere outside of the subject property so that they can live elsewhere while the home is being renovated. It can also be used for expenses to cover expenses around soft costs related to permits, getting plans and specifications, getting the draw inspections completed. Can also be paid, to cover resiliency upgrades, such as retaining walls, foundation retrofitting, storm surge barriers. Also can add an accessory dwelling unit to the subject property, either for, extended families, or it can use, an ADU can be used to, garner additional income. It can be used to even add a manufactured home as an ADU or reno a manufactured home as well, to the extent that the manufactured house is the principal residence. So all of these things can be used with our kind of comprehensive Choice Renovation product, which, next slide, if you look at the slide, we can use up to 75% of the as completed value of the property to cover reno expenses, and about half of the amount that is financed can be drawn up front to cover the cost of materials. The benefit here for both the consumer and an efficiency for the lender doing the financing, it can be done with one loan instead of getting a construction loan to complete the renovation and then taking out a mortgage for the final financing. It does save on time and money with one loan to do both the construction, and also the final is basically the same loan, right? The final takeout. And so what that means for both the consumer and the lender is the lender can just use the first mortgage lien essentially to cover the renovation costs and deliver that loan to Freddie Mac even before the renovation has even started. It does require a minimum contingency upfront to be included or to be held in an escrow account, just in case there's any surprises that is uncovered during the reno. But as I mentioned, it covers a broad range of renovation activities that can be done on the home. So what does this mean in terms of Renovation Express? So in terms of operational execution, the flagship product, Choice Renovation, does require a lender to establish a number of processes that's an additional to the origination of a traditional mortgage to support basically the management of escrow, the inspections that would need to be monitored, making sure the reno stays on schedule, and also just the overall management of the activity until the reno is complete. With Choice Reno Express, we heard from the market that there is a desire to have an in-between reno product that can cover small-scale projects. What we did put to market last year is a streamlined product that allows a lender to have reduced operational processes, however, still get the benefit of some of the financing mechanisms that's allowed for a choice reno activity, where they are able to deliver the loan before reno is complete. There is a shorter time frame for construction to be complete. It's 6 months versus 12 months. And it can be used as an instrument for smaller scale projects up to 10% of the home's as completed value, or in areas that are what we call high needs. It's areas that are persistently poor. That amount is increased to up to 15% of the home's as completed appraised value, essentially to encourage more lenders, a diversity of lenders looking at communities where they could use reno as a tool, both for maintaining the home and also as a gateway tool for entry into homeownership. A more streamlined product that can be adopted quickly to leverage for renovation. And the reason why we chose Reno Express is we saw the difference in adoption rates and execution because of our Green Choice mortgage product. And so if you want to skip to the Green Choice slide, Green Choice is a streamlined version of Choice Reno, but it was focused on energy efficiency or water improvements. And so that we realized the way we had structured the Green Choice mortgage product, it did lend to quicker adoption because of reduced operational processes that needed to be established. The Green Choice mortgage product supports the financing of energy or water efficiency improvements. Predominantly usage today has been around the purchase and installation of solar panels. However, it allows for a broader set of energy or water efficiency improvements to be put on the home. But we saw with the execution of Green Choice that there is definitely an appetite for a smaller scale renovation product to be adopted quickly into the market and supporting both entry into homeownership and to be able to add improvements post homeownership at closing and or updates for existing homeowners. And so with that, wanted to mention that again, all of these products work in concert with low down payment solutions. So our flagship low down payment product is Home Possible. We also have HFA Advantage as we work with our state and local HFA partners to offer low down payment solutions. And also there's the Home One product that offers a low down payment flexibilities as well. And thank you.
So thank you very much. Let me just ask real quick, what's the impact of this renovation suite to date on serving LMI households and also minority households?
Oh, great question. And so today we have seen most of the adoption today has been on our Green Choice mortgage product. We have seen in terms of impact to low and moderate income households, 48% of the volume that we, in terms of mortgage purchases that we had in 2021, went to the low and moderate income segment on the Green Choice. And of the total volume, which we had close to 870 million in terms of total unpaid principal balance or UPB, 30% of that volume were loans to minorities. So Green Choice definitely had a great impact. Choice Reno, the adoption rate, because of the scope of the offering and what it provides, has been adopted at a slower rate. However, in terms of impact, approximately 30% of our mortgage purchases under Choice Reno served low and moderate income households, and about 20% of the total volume in 2021 were loans made to minorities under that product as well.
Great. Well, thank you very much. That was wonderful. I want to thank this fabulous panel for talking about all the wonderful initiatives you've been working on. And with that, let's move to the second panel on what it all means.
Thank you so much, Laurie, and the first panel for the presentations on these innovations on advancing home ownership opportunity to narrow racial disparities. We now turn to our extraordinary panel of experts to reflect on what we've heard and more generally to ask the question of how do we leverage and enhance these programs to overcome these ongoing disparities. The panel that we have to reflect is extraordinary. We have with us Lisa Rice, who is President and CEO of the National Fair Housing Alliance. We are also joined by Robin Weissman, who is Executive Director and CEO of Pennsylvania Housing Finance Agency. We also have with us Risa Agamirzadeh, who is Executive Vice President and Head of Community Development for Citizens Bank, and Yannicka Radcliffe, who is Vice President of the Housing Finance Policy Center of the Urban Institute. Lisa, may we start with you? We have heard about actions on appraisal, special purpose vehicles, and FHA and GSE plans to help overcome racial homeownership gaps. Please start us off on the overall need for these programs and others that could go beyond these. Lisa?
Hi, Susan, and thank you so much for inviting me to participate in this really important conversation, and I'm really honored to be here. And I want to commend first the federal agencies on the plans and programs and the policies that they are putting in place to help overcome racial homeownership and wealth gaps. These programs are long overdue, given our nation's long history of discrimination. We've inherited a deeply inequitable housing and lending landscape that was really built by thousands, literally thousands of race-based policies. And these unjust policies created systems like residential segregation, the segregation of our resources, biased technologies, restrictive zoning ordinances. They also created our dual credit market, in which mainstream lenders are highly concentrated in predominantly white communities, while high cost and non-traditional financial institutions are highly concentrated in predominantly Black and Latino areas. And all of these systems, which are very much present with us today, were designed to be inequitable and to drive unfair outcomes. These systems are still doing what they were designed to do. They're still perpetuating discrimination and racial disparities despite passage of major civil rights laws. And this is really, Susan, because our civil rights laws are focused on stopping discrimination at the transactional level, right? They're not fully designed to dismantle inequitable systems and then replace them with systems that are fair and equitable. And so that's why the programs that the previous presenters have all mentioned are so critical. And in fact, the National Fair Housing Alliance and other civil rights organizations have called for and championed all of these measures. So for example, the National Fair Housing Alliance supported and generated research that helped us demonstrate that using rental housing payment information would be a critical underwriting tool that would advance racial equity. We completed a comprehensive analysis of the appraisal industry and called for a complete overhaul of the system. In our analysis, we have about 50 recommendations for overhauling the appraisal system. So we fully support the PAVE report that incorporates many of those recommendations and then some. We also produced a comprehensive fair housing analysis that illustrated that special purpose credit programs implemented correctly do not violate the Fair Housing Act. And of course, HUD came to that same conclusion when it issued its guidance. Addressing environmental injustice is central to advancing equity. And of course, we can never achieve these important goals without enforcing our nation's fair housing and lending laws. So everything that has been mentioned by the presenters is critically important. I mentioned earlier that we've passed thousands of race-based policies that created deep disparities. So I think it makes sense. I think everybody can understand that it will take thousands of equity-centered policies and programs to get us to where we need to be. But I'd like to just mention 3 additional ones, in addition to what the previous presenters talked about. The first is using first-generation down payment assistance programs to provide support to low-wealth households that have the income required to become homeowners, but they just, because they are low wealth, because people of color have not been able to pass down wealth intergenerationally, people don't have the wealth for a down payment. So first generation down payment assistance programs, if fully funded, would significantly reduce the racial homeownership gap. And in fact, it would reduce the white-black homeownership gap by 5 percentage points. And it would also go a long way to reducing the racial inequity wealth gaps. The second is eliminating loan level price adjustments that were put in place during the Great Recession. These surcharges on price are based on credit score and loan to value ratios, and both of those are highly correlated to race, and they aren't really the best indicators of a borrower's ability to repay. LLPAs increase pricing for consumers of color in a system in which borrowers of color already typically pay more than their commensurate level of risk. And then the last one I'll mention, Susan, is reconstituting the President's Fair Housing Council, which brings together the heads of all of the federal agencies to ensure that all federal programs and policies are affirmatively furthering fair housing.
Thank you very much, Lisa. This was wonderful to hear your overall comments and particularly your 3 recommendations. I am now going to turn to Robin Weissman. Robin, your organization just released an important study on barriers to home ownership. Do you want to reflect with us any results of this, any highlights, and how this may reinforce what we've just heard from the first panel and also from Lisa on the problem that is facing us and the importance of fair and equitable access to credit to solve them, and perhaps comment briefly on what you've heard as well from the first panel. Thank you, Robin.
Thank you so much. Can everyone hear me? I think
yes, we can.
Good. Well, first I want to say I'm really encouraged to hear about all of the federal programs that are in place to address so many of the targeted needs that potential homeowners require going forward. It's very exciting. I think we are sort of at a tipping point where we can start making real inroads here. And you're correct. The study that we did was very confirming of a number of the things that have been said. We commissioned Ira Goldstein of the Reinvestment Fund to study the experiences of prospective first-time home buyers in the Commonwealth. And we released it at our PHFA's Multifamily Housing Conference last week. There are a couple of things that are sobering here and some that may be a little bit new. The first one that is sobering is that from 2000 to 2019, the home ownership gap in Pennsylvania has widened from 25 to 30 percentage points, with 73% of home ownership for white Pennsylvanians and only 43% for Black Pennsylvanians. So we clearly have not moved in the right direction or the preferred direction. The other thing, and this is really quite remarkable, is that we all know that and the study focuses on this quite a bit, we all know that intergenerational wealth plays a large role in the home ownership gap. And Ira actually looked at passive income as an indicator of wealth, because we all know if you have passive income and some degree of return on whatever investment, even if it's a bank savings account, that helps you accumulate financing to generate wealth yourself. So, but the report found that only 1% of Black renters and 5.8% of Black homeowners had assets that generated over $500 per year. That's really, really a de minimis amount. And if you compare that, 18.5% of homeowners and 7.4% of renters in the white population had assets that generated over 500. Number one, it does say something about how important improving affordability of rentals is, so that there's money left over to take care of other things. But the disparity, again, is quite significant. And then the other thing that I think is of note is that only 3.8% of the well-qualified white applicants were denied, compared to 10% of Black applicants. And of less well-qualified applicants, 12.1% of white applicants were denied, compared to 18.6% of Black applicants. So I think the disparity and the variance is clear across the board. The many reasons why we have to work on improving these ratios, and they're all pretty consistent. They're pretty well aligned. And it's even worse in metropolitan areas. And the combination of starter home inventory, which we know we don't have enough of, the increase in median home prices, and the investor activity in the naturally occurring affordable housing are creating quite a perfect storm. Nevertheless, with the programs that you just heard from federal agencies and a number of programs that we, PHFA, is initiating, we remain undaunted and will persevere to make improvements and make lives better for Pennsylvanians. We have terrific products, which I can talk about, and we have a couple of pilots that I do want to mention, where we are working on a homeownership pilot project to increase minority homeownership in targeted areas of Pittsburgh and Allegheny County. And we are obtaining philanthropic foundation support for that. We just received a $500,000 award from the Heinz Endowments to just kick off this effort. We're committing over $5 million in loans, which would in dollars for the loans, which will be about 190 loans. And there are specific census tracts that will benefit. So very important. Hopefully, I like to obtain a model and replicate and not have to reinvent. Hopefully it's something that will work well with specific flexibility in underwriting. Some of the things have just been mentioned, and it will be something we'll be able to extend across the state. The one other pilot, and then I'm happy to talk about our programs when you would like me to. But the other pilot I just want to mention is about, which is also very significant for the minority population, is we were selected as one of the initial grantees through the Robert Wood Johnson Foundation and the NCSHA Healthy Housing, Healthy Communities pilot. And through this, we will receive a certain about $150,000 for a planning effort over 18 months. But as you know, this is to make sure that there's healthcare readily accessible through housing and bringing healthcare to where people live. With that, I'll pause in case you have see what else you would like me to cover, or wait until other panelists are done.
Thank you very much, Robin. And we would like to hear more on the specifics in our conversation. But let's now turn to Risa, Risa, you work every day on getting to mortgage solutions to overcome barriers. How will these programs that we've heard today about and others help?
Susan, thanks. That's first. I want to thank you and everyone for allowing me to join this group and be on the panel with such esteemed colleagues. I really appreciate it. I think all of the programs that have been identified will have a positive impact on our ability to serve the underserved community, and it's just one more tool in the set of tools available for us to leverage. And I think we'll have definitely a positive impact. I think the one thing to remember as we're implementing all of these various initiatives that were just discussed is that it will take time for the industry to incorporate these new programs in their operating model, in their systems, and be able to deliver them at scale. I think when we were talking about, for example, Fannie Mae's initiative to include rent in the underwriting processes, for the industry to upgrade their approval systems and their internal systems to incorporate those, that will take time. So there is a time lag that I think we all need to be attentive to between introduction of an initiative and its full implementation and realization of the benefits. And I think the other aspect that's important, that's also very heartening, is the recognition that I think Susan mentioned it really effectively. There are thousands of reasons where we are where we are, and we need thousands of solutions to address the problem as we move forward. So I think each of these initiatives will have incremental benefit, but in and of themselves are not sufficient to address the gap that exists, that we need to continue to focus on bringing additional resources and additional initiatives to bear to address this, and making sure that activities that we're engaged in can be scaled up, particularly with support with FHFA. I think James mentioned it very well, that when we're talking about special purpose credit program, for example, for those types of initiatives to have the impact that we all desire, they have to be scalable, which means there has to be a secondary market outlet for it. So I think that continuing to work on this, as well as bringing the scale that the secondary market participants can bring to the industry, is going to be critically important for us to achieve the overall target that we're hoping for. Susan, I think you're still on mute.
Yes, I am. I thank you very much. And thank you, Risa. And we now turn to Yannicka of Urbanist. Yannicka, the Housing Finance Center has done so much research on all of these issues. If you'd like to comment on a very general of where we are on racial disparities in home ownership, but then specifically, let's pivot to what we heard from the first panel. And perhaps you can start us off with talking about appraisal solutions.
Okay, well, I want to start from the big picture. To Reza's point, we just heard about a lot of different initiatives from that terrific panel, and all of them have some potential to expand opportunities for home ownership. Some explicitly have a racial focus, and others, aim at increasing affordability for first-time home buyers. And then at the top of the event, as Teresa mentioned, there's the recent interagency announcement on CRA changes. And just yesterday, the White House announced a set of actions to ease housing cost burden. So it's really quite something to consider all these pieces together at one time. And the sum of the parts suggests a greater whole that recognizes there's no simple, single silver bullet solution to the entrenched, and according to our research, even widening racial gaps in home ownership rate and housing wealth. And Lisa and Robin have both just spoken to those things, but we know that the Black-white home ownership gap is as big today as it was in 1968 when discrimination in housing was made illegal. And we actually see divergence along the lines of housing wealth and how that has accumulated differently and continues to compound, and that gap continues to grow. So all these efforts recognize that we have to come at it at multiple fronts. And it seems to recognize a sense of urgency as well, that if we don't get into real action, the gaps are likely to get just more and more entrenched. So I feel like it's a really unprecedented and timely opportunity for conversations just like this, so that stakeholders can stay informed and can weigh in. can hold the decision makers and the key actors accountable, and actually leverage and implement the opportunities, as Reza talked about. So if we can then drill down into the appraisal issue, it's a really interesting example of this, right? And I want to focus specifically on AVMs, or automated valuation models. It's natural to assume that if you just take people like appraisers out of the equation, then you've magically removed the bias as well. But systemic racism gets baked into the system, where it becomes harder to detect and ferret out. We sort of already learned that lesson with the widespread implementation of credit scores. So my colleagues, Michael Neal and Lena Zhu, have taken a look at AVMs and found that there's a higher percentage of error, even in the automated valuation, right? And I'm talking about the difference between the value predicted by the AVM and the sales price as a percentage of the sales price of the house. And this error is higher in majority Black neighborhoods than in majority white neighborhoods in all the cities we looked at. And even after we control for a bunch of factors that you think would explain that, like home value and property condition and neighborhood factors, we still find this unexplained and significant difference in AVM error in majority Black neighborhoods. So that just goes to show you can't assume that if you automate something, you remove all the racially based barriers. So that's why it's important for things like the PAVE task force actually identified this and has some specific actions that speak directly to this concern about AVMs through a rulemaking approach that will seek to address potential bias in the use of technology-based valuations. And what that can lead to is, if we're attentive to things like quality control and making sure there isn't an unintentional bias baked into the system, AVMs can then actually become a tool for reducing valuation bias and a solution. So that's just one example of how we really need to think comprehensively and really look for the ways in which these biases and these inequities are baked into our very system.
Thank you, Yannicka. I would like to now turn to the other panelists for comments on specific programs. And let me start with you, Robin. How is PHFA thinking about appraisal and potential use of special credit programs and some of the other programs we've heard about? And how do we find out more about what you are doing?
Certainly. Well, we are very proactive in our single-family mortgage market. As you know, we have a very, very large portfolio, and we're working very hard, not only on making it affordable in terms of the interest rate, but accessible in terms of obtaining a mortgage. And a lot of that revolves around the credit criteria that has been discussed. And we are working through the pilot that I referred to, but also in terms of our existing products, K-Fit and a K-Flex product, and looking at slightly different underwriting standards with other considerations, such as the ability to repay. But clearly the largest factor, which was highlighted by the point on the lack of ability to generate assets by minority potential homeowners, is the down payment. We all know that the down payment is the most significant obstacle, and we are addressing that head on with some of our statewide programs. One is the K-Fit program, and we have up to 95% financing. As we all know, in the commercial market, it's typically a 20% down payment. But our down payments can run from 5%, 3% to 5%, and some down even to 1%. So our forgivable loan program, or forgivable down payment program, is quite robust. And we've now just recently augmented that with our newest program, which is called the K-Flex, which can be paired with the down payment assistance loan program. And that takes into consideration more challenges as it relates to credit ratings, whether it's student loans or and rental payment record, that sort of thing. So we have, and I'm pleased to report that In only 2 months, we've had over 82 locks for over 20 million already. So clearly it's addressing a need for flexible underwriting and down payment assistance.
Thank you very much. And we now have some specific questions from the audience that I would like to pose. Starting with, are there concrete examples of special purpose credit programs that are currently in operation, or is this all kind of forward-looking? Does anyone want to comment on that? Or that might be the...
Sure. Sure, I can start out. Yeah, there are lenders who have implemented special purpose credit programs. And since HUD issued its guidance recently stating that special purpose credit programs do not violate the Fair Housing Act, we've been contacted by a number of not only financial institutions, but nonprofit organizations that want to stand up these programs. And in fact, the National Fair Housing Alliance is working with the Mortgage Bankers Association and the Urban Institute to develop a special purpose credit toolkit to help entities formulate their own special purpose credit programs. But JP Morgan Chase has a special purpose credit program that has been in operation for a little over a year. They're seeing great results from that program. And if folks want to learn more about the JP Morgan Chase program, NAFA, the Urban Institute, and MBA, again, co-sponsored a webinar on SPCPs that you can find on our website. Just go to nationalfairhousing.org and search for special purpose credit programs in the search engine, and you'll find a link to that webinar that features representatives from Chase. Wells Fargo just announced that it is standing up a special purpose credit program, and we anticipate that other lenders will be doing the same.
Thank you very much, Lisa. Are there others that would like to comment on SPCPs? And if not, that was very helpful, Lisa. I'd like to pull us back to what we heard earlier, and specifically what we heard from the GSEs on the rent, using rent, and on new rehab loans, and also more generally on FHFA equity plans. Yannicka, you have commented on these, at least the Urban Institute has. Can you tell us how you see the potential for the specifics and the more general directions that the GSEs are heading in?
Thanks for that question, Susan. The GSEs are obviously, positioned to have a strong influence on the whole housing finance system. And the FHFA recently asked for comments, and they actually asked the GSEs to develop plans on equitable housing finance and how they explicitly were going to go tackle these problems we've been talking about. So we commented on that, and I can just give a really high-level overview. We commented on how a strong and purposeful commitment by FHFA and the GSEs, Fannie Mae and Freddie Mac, can work to undo the legacy of racism in housing finance. And basically, we had 3 parts to our recommendation. We first start by recommending that following FHFA's lead, Fannie Mae and Freddie Mac establish a clear vision, measurable, transparent goals that they can be held accountable for. Secondly, that they operationalize those goals by really building equity into their business model, not just as kind of a nice to have on the side thing, but really fundamentally woven into their business model. So I can give 3 examples of how to do that. One, some of our previous panels have touched on the importance of more flexible mortgage underwriting standards. And in particular, one specific opportunity is to facilitate their use and their targeting to underserved populations through the use of special purpose credit programs that Lisa just talked about. Another thing they can do, and Lisa mentioned this as well when she talked about the LLPAs, the loan level price adjustments, they can use their pricing as well as their credit risk transfer approaches to advancing equity goals, and very deliberately use these tools towards those ends in a safe and sound manner. And then there's another set of tools around establishing pilot programs that can lead to more home ownership opportunities for households of color. So intentionally unleashing some of their key tools to really advance these equity goals. And then third, more generally, they can use their position to set equity standards for the entire housing finance system because of their central role. So those are some of the things we hope to see the plans coming out soon, and we'll see how the GSEs are going to be implementing them.
Thank you, Yannicka. I want to ask Lisa, you also to comment on the forward-looking plans, although you already have given us your wish list, which is, of course, would be transformational. And I also have a very specific question on that from the audience, which is, what are the parameters for first-generation down payment assistance for low-wealth households? What would it take to fund it fully? Please go ahead, Lisa.
Sure, thanks for the question. And I also invite Yannicka, who worked on this. She led the team that did the research for our first gen program to respond as well. So we believe that the program needs to be funded at $100 billion. If we fund the program at $100 billion, that will serve about 5 million consumers, 70% of whom will be households of color. And that, as I said, would bring the Black homeownership rate to about 50%, which is a major goal for the Black Homeownership Collaborative, which is a coalition of about 100 organizations who are working to reduce the racial wealth gap. In terms of the eligibility criteria, the borrowers would have to be first generation, first time home buyers. That is, the borrower, the applicant, can't have owned a home in the previous 3 years, and their parents cannot currently be homeowners. We are suggesting a median income limit of 120% of the area median income. We also are suggesting that these loans, the program only be available for borrowers who are getting qualified mortgages. And there's also a requirement for pre-purchase, counseling by HUD approved housing counseling agencies. So I hope that helps.
Yeah, that absolutely does. Yannicka, do you want to expand on the study?
I mean, Lisa has it down, but I will say that, as we heard from Robin, our research as well just shows the primacy of home ownership, intergenerational home ownership. We found that households whose parents, young adults whose parents are homeowners, are much more likely to become homeowners themselves and do so earlier in life, which is really the key to that long-term wealth building, which leads to further intergenerational wealth. We also see that there's a huge gap between the assets, the median, when you look at the median net worth of the parents of white young adults, it's over $200,000. When you look at the median wealth, that it's at the disposal of the parents of Black young adults, it's like under $20,000. So barely enough. If they help their child make a down payment, they wouldn't have any nest egg left to fall back on themselves. So this long-term intergenerational lack of opportunity to tap into building wealth through housing finance, which has just been exacerbated through the recent pandemic, when homeowners now have interest rates, of historic lows, locking in long-term affordable housing. They're benefiting from lots of appreciation in the market, and renters are just stuck watching their rents go up 20% year over year, and putting homeownership potentially further and further out of reach. So I can't emphasize enough the importance, and we've all heard it from all the panelists, of addressing this lack of intergenerational wealth.
Thank you, Yannicka. We are coming to the end of today's program. I do want to bring back again what we heard from Teresa Singleton at the beginning of the program, that we, our early days, just heard about two new federal initiatives. One, of course, is the proposed rulemaking on the Community Reinvestment Act, and the other is the White House announcement on reducing cost burdens. I'd like for the panelists perhaps to briefly, in this closing period, to address both starting to the extent that they can wish to, starting with the Community Reinvestment Act. We have heard just this past minute about, from both Lisa and Yannicka, overcoming intergenerational barriers to homeownership, but there are also place-based barriers. What might happen, and of course these are, this is not perhaps fair, we just have this NPR, but would anyone like to comment on the potential overcoming place-based barriers through the CRA as it has been newly proposed rules? Lisa, again, would you mind starting us off? Would you want to?
Sure, I'm happy to do that. I would be less than honest, Susan, if I didn't say that I was a little disappointed to not see race included explicitly in the CRA rule. Having said that, the increased attention to fair lending issues, which was very critically important for us, was important to see in the CRA NPR. In other words, if a lender is found to have violated a fair housing statute or a major civil rights statute, that can and potentially would result in the lender being downgraded in their rating, in their CRA rating. And we really applaud that, because for too long we've seen instances where lenders were found liable to have violated a major civil rights statute, but then they were receiving outstanding CRA rating. And that just didn't seem to be a lot of alignment between the CRA goals and the fair lending goals. So we're happy to see that adjustment made in the proposed rule.
Robin, would you like to comment on the CRA?
Sure, thank you so much. I've been thinking about the CRA for quite some time. And of course, I'm still very interested in not just the place-based focus, but of course, all of the CRA requirements for non-depository lenders, which of course is not in the jurisdiction. So that's such a large part of our lending system right now. I think it needs to be addressed somewhere, because there's a CRA responsibility for those lenders as well. But having said that, I have an appreciation, as Lisa just mentioned, I have a real appreciation for concerns about challenges and to race-based initiatives. And I would just suggest that if we have a very robust census tract, place-based requirements for CRA that are based on socioeconomics, we will be able to target the same market, because they are inextricably linked. So I will choose, I can make the same comments and agree, but I can choose to be hopeful that with the increased focus on place-based lending, that it will make a difference. One of the things, Susan, if I may just say, with all of the resources that have been discussed today, I do think it's critically important that we all think through and determine or make some inroads to help the consumer navigate the resources. There's a multiplicity of resources. We think it's coming on, and I just maybe that's something that CRA could even do in terms of the responsibilities of some of the lenders to provide a clearinghouse for information for the consumer who's trying to figure this all out.
With that hopeful comment, we come to the end of today's program, and let me thank this extraordinary panel for their very thoughtful comments and ongoing work on these critical issues for our nation for fair and equitable lending. Let me also thank our partners, the Urban Institute and the Philadelphia Federal Reserve Bank, for their assistance on this program and the program to come, which, may I remind the audience, we have a second program in the series On July 12th, from noon to 1:30, please join us on Advancing Homeownership Opportunities to overcome narrow racial disparities in home ownership using programs on the local level. Thank you to all, and thank you to you, the audience.